One line on your 2024 tax return just raised your 2026 Medicare bill by nearly $1,000. Not because anything changed with your health, not because you missed a payment, because your adjusted gross income crossed a threshold you did not know was there. Not your doctor, not your plan. Your Maggie. The total of your AGI and any tax-exempt interest income. That threshold is called IRMAA. For most retirees, the first they hear of it is the Social Security notice saying their Part B premium jumped $81 a month. And because Medicare always looks 2 years back, what you earn this year is already building toward your 2028 bill. That is one of 4 rules that shifted for 2026, and any one of them can cost you, or save you, real dollars. Before this year is out, one carries a 25% IRS penalty if you miss the deadline. Another is a catch-up window that closes permanently once you pass a single birthday. I am your guide to the retirement math your advisor may not have called you about yet. In the next 15 minutes, 4 things: the COLA raise and the IRMAA trap, a brand new senior deduction, the RMD start age, and the super catch-up window. Change 3 is the one with the penalty. We will get there. Quick favor before change 1. If staying current on rules like these matters to you, tap subscribe now so the next update reaches you before a deadline does. Change 1. The COLA raise and the Medicare trap. It can trigger. According to the Social Security Administration's 2026 COLA announcement, benefits went up by 2.8% starting in January 2026. On the average retirement benefit, that works out to roughly $56 more per month, from about $2,015 to about $2,071. On a survivor benefit, the same increase added roughly $52 a month. 2.8% does not sound life-changing, but COLA is permanent. Every year's increase layers on top of the last one, and that effect compounds over a 20 or 30-year retirement. The planning problem most people miss is the 2-year lag, and it runs in both directions. Looking backward, your 2026 premium was already locked in by your 2024 tax return. Looking forward, the COLA you got in January is permanent. It goes into your 2026 income, and your 2026 income is what Medicare will use to set your 2028 bill. Every Roth conversion, every capital gain, every required withdrawal you take in 2026 stacks on top of that COLA and pushes your future IRMAA threshold closer. Medicare uses a number called Maggie, your AGI plus any interest from tax-exempt bonds, because that is the broadest measure of income available on your return. For 2026, the standard Part B premium is $202.90 a month if your 2024 Maggie was $109,000 or below as a single filer, or $218,000 or below as a couple. Cross that line by even $1, and it jumps to $284.10, an extra $81.20 a month, $974 a year per person, nearly $2,000 a year for a married couple, just because income crept over a threshold, and that can happen automatically, triggered by a Roth conversion, a capital gain, or a required withdrawal you did not plan around. The term for this is IRMAA, the Income-Related Monthly Adjustment Amount. Most people have never heard of it until they get a notice from Social Security saying their Medicare premium went up. The action from Change 1. Enjoy the raise. Then pull your 2024 tax return and find your Maggie. If you are near that $109,000 line as a single filer, or near $218,000 as a couple, it is worth a conversation with your tax preparer to understand whether you crossed it, and whether a qualifying life-changing event, such as retirement, a reduction in work hours, or the loss of a spouse, may give you grounds for an IRMAA appeal using Form SSA 44. Change 2. The new $6,000 deduction. The senior tax break. That sunsets in 2028. This one is new. Brand new. Under the tax legislation passed in 2025, taxpayers who are 65 or older can claim an extra $6,000 per person off their taxable income for tax years 2025 through 2028. If you and your spouse are both 65 or older, that is $12,000 total. This stacks on top of the standard deduction, $16,100 for a single filer in 2026, $32,200 for a couple filing jointly, and on top of the existing age 65 extra standard deduction, which adds $2,050 for unmarried filers, or $1,650 per qualifying spouse for married couples. Let me stack those numbers so you can see the full picture. A single filer who is 65 or older starts with the $16,100 standard deduction, adds the age 65 extra of $2,050, adds this new $6,000 senior deduction. Total, $24,150 of taxable income reduced before a single itemized deduction. For a married couple where both spouses are 65 or older, $32,200 plus $3,300 in combined age 65 extras plus $12,000 in the new senior deduction, $47,500 off the top before medical expenses or charitable gifts. The deadline? This expires after the 2028 tax year. 4 years, and they go fast. And this deduction is aimed at middle-income retirees, so it phases out gradually once Maggie climbs above $75,000 single or $150,000 married. Check IRS.gov or ask your preparer to run the exact calculation if your income runs past those lines. The action step: when you sit down for your 2025 taxes, confirm the new senior deduction was included. Do not miss a deduction that could reduce your taxable income by $6,000 or $12,000 if your spouse qualifies too. Change. 3. Your RMD age. Depends on the year you were born. This is the one I want you to pay close attention to. A required minimum distribution, an RMD, is the amount the IRS forces you to withdraw each year from your traditional IRA, 401k, 403b, and most other tax-deferred accounts. The mistake I see people make is assuming everyone starts at the same age. That has not been true since Secure 2.0. If you were born between 1951 and 1959, your RMDs begin at 73. Born 1960 or later, they do not begin until 75, a 2-year difference. Someone born in 1953 turns 73 in 2026 and must start this year. Someone born in 1960 does not reach RMD age until 2035. Your first RMD has a grace period until April 1st of the following year, but every RMD after that is due by December 31st. And if you use the grace period, you will owe 2 RMDs in that calendar year, which can push your tax bracket or your IRMAA threshold. For many people, it is cleaner to just take the first one in the year they actually hit RMD age. Miss an RMD, and the penalty is 25% of the amount you should have withdrawn, 10% if you catch and correct it within the IRS correction window. Neither number is one you want to pay on an avoidable mistake. For most retirees, the RMD amount in the first year is roughly 3.7 to 4% of the account balance. The IRS uses a life expectancy table to calculate the exact factor for your age each year. Your account custodian will usually tell you the number each January, but the responsibility for taking it on time is yours, not theirs. The planning angle that matters most: if you're 62, 63, 64 right now, that window before your RMDs begin is exactly the right time to look at a Roth conversion, paying the tax today at your current rate so that money is never subject to an RMD later, since a Roth IRA has no required minimum distributions during your lifetime. That window is cleanest before RMDs start. Conversions can still happen after, but the RMD must come out first each year. Either way, a conversion adds to your taxable income in the year you do it, which can itself push your Maggie over an IRMAA threshold. Run the numbers first. Change 4. The biggest catch-up window in history, and the age that most people do not know about. If you are still working, 2026 brought a meaningful increase to workplace retirement contribution limits. The standard 401k or 403b limit is $24,500, up from $23,500. If you are 50 or older, catch-up contributions add $8,000, bringing the total to $32,500. But here is the window most people have never heard of. If you are between 60 and 63, specifically 60, 61, 62, or 63, you qualify for what is called the Super Catch-Up under Secure 2.0, $11,250 instead of $8,000, bringing the maximum to $35,750 a year. Think about that. $35,750 into your workplace plan in a single year. In the 22% bracket, that could defer nearly $8,000 in federal taxes in 1 year alone. This window is available only for the tax years in which you're 60, 61, 62, or 63. The calendar year you attain age 64, the Super Catch-Up no longer applies. Secure 2.0 uses your attained age during the tax year, not your birthday month. If you are in that range and still earning income, do not wait. On the IRA side, the 2026 limit is $7,500, and the 50-plus catch-up adds another $1,100, now indexed to inflation for the first time, so it will grow over time rather than sitting flat. Putting it all together, your 4-item checklist. Before year-end, here is what to actually do with the 4 changes we just covered. First, pull your 2024 tax return. Form 1040, line 11 for adjusted gross income, and add any tax-exempt interest. That is your Maggie. Compare it to the IRMAA threshold for your filing status, $109,000 single, $218,000 married filing jointly. If you crossed it, confirm your Part B premium. Do not guess at it. Second, if you are 65 or older and have not filed your 2025 taxes, confirm your preparer included the new $6,000 senior deduction, or $12,000 if your spouse qualifies too. Third, know your RMD age, 73 if born 1951-1959, 75 if born 1960 or later, and if you're approaching it, mark the April 1st deadline for your first one, and seriously consider taking it in the year you actually hit that age rather than using the grace period. Fourth, if you are 60 to 63 with earned income, look at whether you're using the Super Catch-Up, $35,750 into a 401k or similar plan in a single year, before the window closes at 64. These are not abstract rules. They are specific numbers, specific dates, and specific decisions with real dollar consequences this year. Here is the one rule that ties all 4 together. Every retirement dollar has a tax shadow, and your job is to see it before the IRS or Medicare does. This is not financial advice and not legal advice either. Every situation is different. Run these past a qualified tax professional who knows your full picture. Like this video if it was worth your time. Subscribe for plain English retirement tax updates before the deadlines hit. And if this helped you see something you needed to know, leave a comment with the word checklist.